What's the difference between planned premium versus target premium with respect to IUL, Indexed Universal Life? It's amazing how many agents do not understand this, and hence their clients do not understand it. I'm shocked how many IUL policies are structured at target premium, and that becomes the planned premium, and I'm going, oh dear. These people are going to be lucky to earn an average of 6 or 7%, but they're only going to net 1 or 2% on an internal rate of return basis because they're only paying target premium. So get ready. I'm going to educate you on how to make sure an IUL policy is structured correctly to optimize your rate of return. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for 5 decades. And as a retirement planning specialist, my goal is to help clients prepare for a comfortable retirement where they will not outlive their money. And I've discovered that most retirees following the herd, putting their money in the market in tax-deferred IRAs and 401ks, end up outliving their money due to the negative impact of taxes, inflation, and market volatility based upon the general advice given in the financial services industry. Hang in there, keep your money in the market always comes back. Well, Wall Street was never designed to create predictable cash flow or income. And so when people start to learn why my favorite vehicle is a max-funded IUL, they start coming across terminology. And there's a lot of agents who are licensed to sell IUL, but they don't take the time to learn definitions of terminology, and then they just trust what the carrier or their independent marketing organization creates for an illustration for the amount of premium that the client says they can afford to put into a policy. So I'm going to super simplify this. So many times if an agent were to meet with somebody and say, okay, this is an incredible tool here, IUL. And Doug Andrew, this is his favorite tool. And so how much can you set aside into one of these policies in lieu of maybe putting that same amount of money into a tax-deferred IRA or 401k? And the person says, well, $500 a month. And so what do? They go to their insurance carrier or their IMO, to the person creating illustrations, and they say, create an illustration and calculate the amount of insurance to accommodate $500 a month. And what do? They go in and they put in $500 as if it's the target premium. Oh dear, you can't believe how many policies are set up thinking that they're doing it right by plugging in the amount of money the client's going to put in there, and that's called the planned premium, and they make that the target premium. Why is that a disaster waiting to happen? The target premium is not the maximum you're allowed to put in there. If you want it to become a tax-free cash cow, you want to take the least amount of insurance you can get away with. That's the whole brainchild behind E.F. Hutton coming up with these in 1980. Take the least amount of insurance you can get away with and put in the most premium the IRS allows. Well, that's way more than target premium. Target premium is, as far as the client is concerned, generally speaking, it's a premium the insurance company says, if you pay this target premium from age 35 to age 65, based upon some of the worst case scenarios, the policy will not lapse during that time period if you pay the target premium, okay? Now, target premium means different things to different carriers, but when I started, that's sort of what dictated the target premium. Well, if you pay target, the policy will last until you're age 65, even in worst case scenarios. Well, the target premium is way more premium for the death benefit than you need to pay. You can get away with probably half that much insurance or less if you're saying, what's the least amount of insurance I can get away with? Instead of how much insurance do I get if I pay target premium? So if you pay target premium of $500 a month, based upon your age and your gender and your health, if the amount of insurance for $500 a month, if you're in your 20s or 30s, let's say is $1 million, well, you go, well, wait a minute here. So I get $1 million of life insurance at that target premium. Well, if you were to go in and say, what's the least amount of insurance I can get away with if I want to sock away $500 a month? Then you start using the tax citations, TEFRA and DEFRA, and the minimum death benefit would be maybe half that, only $500,000. Well, that means you're paying for twice as much insurance as you need if you calculate it based on target. You're paying way more. What does that mean at the end of the day? And so many agents don't even understand this. They look at the illustration, and here the client is paying target premium, and at age 65, they've paid, $500 a month, $6,000 a year, which is $60,000 every decade, and it's been 3 decades. They paid in, $180,000, and they don't even have $180,000 of cash value. It's like, oh, that was a good investment. Yeah, why? It's because they did it based upon a target premium. Target premium was never maximum funding it. If they took less insurance, that $180,000 of premiums would have grown to cash values of $400,000 or $500,000 or $600,000 or more. And this is the difference of having this money grow tax-free to where in as little as 12 years, your cash value could grow to equal or exceed the death benefit. If you're age 55 and you're putting in $500,000 the first 5 years, you're taking the least amount of insurance. You could get away at age 60, putting in $500,000, you only need $1 million of death benefit. My heavens, if $500,000 was the target premium, you'd be paying through the nose for way more insurance than you could get away with. So don't do target premium. And sometimes I wonder because target premium is also what the insurance company bases the commission they're paying the licensed agent on. I sure hope that the agent didn't design a policy based on target premium to maximize their compensation. Then they're structuring a policy to benefit their wife and kids instead of your wife and kids, if you know what I'm talking about. That makes me shudder to think that's why they did it. Frankly, I'm going to give them the benefit of the doubt. I think most IUL agents simply don't know what they don't know, and they just follow the illustration prepared by the carrier or by the person who prepares illustrations for the marketing organization, and they just plug in target, thinking they know what they're doing. So what's the essence of all this? If all you do is pay target premium into a policy, you're going to be lucky to have an internal rate of return cash on cash that's anywhere close to the gross crediting rate. If that was 7 or 8, you might be lucky to net 1 or 2. And you're going to be lucky if your cash value after 30 years even is greater than the total of premiums you've paid into it if you're paying target premium. Okay? If you have a planned premium and you take the least amount of death benefit and the planned premium is half or 1/4 of the target, this thing turns into a tax-free cash cow, and now your cash value has grown and can double every 7 to 10 years, so that if you put in $500,000, it grows to $1 million, $1 million doubles to $2 million, $2 million doubles to $4 million, $4 million doubles to $8 million, because you didn't do it based on target premium, you did it based on a planned premium, and you took the least amount of insurance. This is critical, okay? So if you're a member of the general public and you're watching this episode and you're interested in IUL, it's absolutely imperative, in my opinion, that you learn this, and you can learn it by simply reading my book, The Laser Fund. It's my 11th book. It's been flying off of our warehouse shelves. And, it's about a 6 or 7 hour read. You can also listen and learn or watch and learn, but you can go to Amazon and buy this for $20 plus shipping. I'll gift you one free. I'm that passionate about getting the right information out there because this is too good of a thing to have it messed up with agents who don't understand because they're designing it based on just target premium, okay? And so you can claim a free copy by simply going to laserfund.com or click on the link below. You contribute a nominal amount towards the shipping. I require a little bit of skin in the game. I'll cover the rest of that and I'll pay for the book. I'll fire out a hard copy to you via priority mail. But when you're in there claiming your free copy of this book, and it's 300 pages, charts, graphs, and explanations. You flip it over, there's 62 stories on this side of the book. But there's options there if you'd like to listen and learn or watch and learn, video and audio formats. But here's what I want you to do. If you want to make absolutely sure that an IUL policy is structured correctly, the way I'm talking about here, if you don't, it could cost you hundreds of thousands of dollars down the road. Make sure you have it designed correctly. And to make absolutely sure, you can schedule an appointment with a certified IUL professional when you're claiming a free copy of the book. There's no cost or obligation. It's free. And they will create an illustration of one done correctly. When you compare that to maybe the illustration some IUL agent prepared for you, be prepared, there's going to be a massive difference if they prepared it based on that target premium. We do this all the time. Now, you want to have it done correctly by a certified professional. If you are a professional and you're watching this episode, what's the message? If I were you, I would want to make absolutely sure that your client doesn't read this book and watch a few episodes and they know more than you do. That would be embarrassing. If you want to be a professional that does the absolute best job for your clients, go to IULinsiders.com. Become a member of this coalition and network and start to learn how to do it right. The ultimate goal in IUL Insiders is to become certified, to become a certified IUL professional. That's a 100-question proficiency exam, and it's not easy. Most agents wouldn't even score 20% on this exam because they wouldn't understand 80% of the questions. I don't want you to be one of them. So check out IUL Insiders. If you're a member of the general public, claim a copy of the book and work with a certified professional so that you make sure it's structured correctly in the first place and your plan premiums, will be far, far greater than the target premium. And it will perform like an incredible cash accumulation tool that will knock the socks off of traditional plans like IRAs or 401ks invested in the volatile stock market.